If I gave you two choices right now, $1 million today or $6,000 every single month for the rest of your life, which one would you take? At first glance, this sounds easy. A lot of people hear $1 million and immediately think that's life-changing money. And to be fair, it is. But then there's the second option, $6,000 per month. That's $72,000 a year, every year, month after month. So now the question changes from which number sounds bigger to which option is actually worth more. And that's where most people get this wrong, because the correct answer has nothing to do with emotion and everything to do with math. Today, I want to show you exactly how to calculate this so that by the end of the video, you'll know which option is better. When it makes sense to take the lump sum, when the monthly payment wins, and why the smartest answer actually depends on a few details almost nobody thinks about. Let's start with the obvious. If you take $6,000 per month, that adds up to $72,000 per year. So if you divide 1 million by 72,000, you get about 13.9 years. In other words, if you collect that monthly payment for more than almost 14 years, the total cash you receive would exceed $1 million. So does that mean the monthly payment is better? Not so fast, because money today is worth more than money later. This is one of the most important rules in finance. A dollar now has more value than a dollar in the future, because money today can be invested. That means if you take $1 million now, you don't just sit on it. Ideally, you put it to work. Let's say you invest that $1 million and earn a 7% annual return, which is often used as a long-term stock market estimate after inflation adjustments are considered separately. That would generate about $70,000 a year on average before taxes, or roughly $5,800 a month. Notice how close that is to the $6,000 monthly option. That means the decision is actually very close when you use a 7% return assumption. But here's where it gets interesting. If you could earn more than 7.2% annually on that $1 million, then the lump sum starts looking better. If you earn less than that, the $6,000 per month starts to look more attractive. Why 7.2%? Because 72,000 divided by 1 million is 7.2%. That's your break-even rate. So, if you're confident you can invest the $1 million and consistently get more than 7.2% per year, then mathematically, the $1 million now is the better option. But if your actual return would be lower, maybe because you keep the money in cash, or maybe because you're too conservative, or maybe because you panic and sell investments every time the market drops, then the monthly payment could actually outperform what you'd realistically do on your own. And that's the key word, realistically. Because personal finance is not just about theory, it's about behavior. A lot of people say they would take the $1 million and invest it wisely. But what actually happens? Maybe they buy a bigger house. Maybe they upgrade their car. Maybe they lend money to family. Maybe they keep too much in a checking account. Or maybe they make one bad investment decision and suddenly that million isn't really a million anymore. The monthly payment, on the other hand, creates forced discipline. Every month, money comes in. It's predictable. It's easier to budget. It feels like an income stream instead of a one-time windfall. And for many people, that structure protects them from making impulsive decisions. But we're still missing another major factor: inflation. If the $6,000 per month stays fixed forever, inflation makes it less valuable every year. $6,000 today does not buy the same amount 10 years from now. If inflation averages 3% per year, then the real purchasing power of that monthly payment keeps shrinking. That means in 20 years that $6,000 might feel more like $3,000 or $4,000 in today's dollars, depending on inflation over time. Meanwhile, if you take $1 million now and invest it in assets that tend to grow with inflation, like stocks, real estate, or productive businesses, your money has a better chance of maintaining or increasing its purchasing power. So suddenly, the lump sum becomes even more powerful. Now let's talk about risk. The monthly payment sounds safer because it feels guaranteed. But guaranteed by who? If this is just a hypothetical, fine. But in real life, if someone promises you monthly payments forever, you need to ask whether that source is secure. Is it backed by an insurance company, a government program, a private individual, a lottery annuity? Because a guaranteed payment is only as good as the institution behind it. The lump sum removes that uncertainty. Once you have the money, it's yours. No dependency, no waiting, no wondering whether the payments continue. On the other hand, the monthly option protects you from yourself. If someone handed $1 million to a person with no investing knowledge, no financial discipline, and no long-term plan, there's a decent chance they would mismanage it. In that case, $6,000 a month could act like a financial guardrail. So what should the average person choose? If you are financially disciplined, you understand investing, and you're willing to think long-term, I'd lean toward the $1 million now. The reason is simple: flexibility. With $1 million, you can invest it, diversify it, use part of it for opportunities, create your own monthly income, and leave the remainder to grow. You also have the option to adjust your strategy over time. For example, if you put that million into a diversified portfolio and withdrew 4% per year, that's $40,000 annually while still giving the portfolio a strong chance to last long term. If you withdrew 6%, that's $60,000 per year. And if returns are good, you could potentially maintain that lifestyle while preserving principal. But if you choose the $6,000 monthly option, your upside is capped. You get what you get. No acceleration, no compounding on the full balance, no opportunity to deploy a large amount of capital all at once. Now, if you're someone who struggles with money, hates risk, or knows you would overspend a lump sum, then the monthly payment might be the better life decision, even if it's not always the best mathematical decision. And that's an important distinction. The mathematically best choice and the personally best choice are not always the same. So here's the simple framework. Take the $1 million now if you can invest well, you value flexibility, you want inflation protection, and you trust yourself to manage large sums responsibly. Take the $6,000 per month if you need structure, you prioritize predictable income, you worry about blowing the money, or you prefer safety over optimization. Personally, if the monthly payment is fixed and the million is available immediately, I'd probably take the $1 million now, because with the right strategy, that money can do more, grow more, and give you more control. But the real lesson here isn't just which option to pick. It's that every financial decision should be run through a simple filter. What's the total value? What's the investment return? What does inflation do? What are the taxes? And most importantly, what will I actually do in real life? Because building wealth is not about choosing what sounds impressive. It's about choosing what works. And if you can learn to think like that, not only will you answer this question correctly, you'll probably make better money decisions for the rest of your life. Let me ask you a question that sounds simple, but actually reveals how people think about money. Would you rather take $1 million right now, today, no waiting, or $6,000 every month? Most people answer too quickly. They either say, obviously, I'll take the million because that feels big, instant, and exciting, or they say, obviously, I'll take the monthly money because eventually it adds up to more. But both of those answers are incomplete, because whenever you compare a lump sum to monthly payments, you're not comparing two numbers, you're comparing timing, opportunity, inflation, risk, and behavior. And once you understand those 5 things, the answer becomes way more clear. So let's break this down in the simplest way possible. $6,000 per month equals $72,000 per year. That means if you wait long enough, the total amount adds up. After 10 years, you'd receive $720,000. After 15 years, you'd receive $1,080,000. After 20 years, you'd receive $1,440,000. So if you live long enough, the monthly option wins in total dollars received. Case closed, right? Not exactly, because you're forgetting the most important concept in finance, present value. Present value means future money is worth less than money you can use today. Why? Because money today can be invested, and investments can grow. So even if the monthly option gives you more dollars over time, those dollars arrive slowly, and that delay has a cost. Let's say you take the $1 million now and invest it. If you earn 5% annually, that's about $50,000 per year. At 6%, that's $60,000 per year. At 7.2%, that's $72,000 per year. And at 8%, that's $80,000 per year. That means 7.2% is the magic number. If your $1 million investment earns 7.2% per year, it produces the same annual cash flow as the $6,000 per month. Anything above that and the lump sum is financially stronger. Anything below that and the monthly payments may look better, but there's more. The lump sum gives you optionality, and optionality is one of the most undervalued parts of wealth. If you have $1 million now, you can invest part of it. Keep some in cash. Buy assets when opportunities come up, start a business, purchase real estate, pay down high interest debt, create multiple income streams. In other words, you get control. With $6,000 per month, you lose that flexibility. You can cover expenses, you can budget, you can live comfortably in many areas, but you can't suddenly deploy $300,000 into an opportunity. You can't move as fast, and you don't benefit from compounding on the full balance at day one. That's a big deal. Now let's talk about inflation, because this is where a lot of people completely underestimate the downside of fixed payments. If your $6,000 per month never increases, inflation slowly destroys its value. Let's say inflation averages 3% per year. In 10 years, your $6,000 will buy a lot less than it does today. In 20 years, it could feel dramatically smaller. The payment remains the same in dollars, but not in purchasing power. That matters because people tend to think in nominal terms, not real terms. $1 million now can be invested in assets that historically rise over time. Stocks, businesses, real estate, these are imperfect, but but they at least give you a chance to outpace inflation. A fixed monthly payment does not. Now let's flip the argument. What if taking the $1 million is actually a terrible idea for some people? Honestly, for a lot of people it might be. Not because the math is wrong, but because behavior is stronger than math. If someone has never managed money before, suddenly getting $1 million could be dangerous. Lifestyle inflation kicks in. They buy things they don't need. Friends and family start asking for loans. Bad investments start looking attractive. And within a few years, the money is gone. It happens all the time. That's why structured income can be so powerful. $6,000 per month creates boundaries. It spreads out the money. It forces patience. And if you're not naturally disciplined, that might actually produce a better long-term outcome. This is why the smartest financial decision is not always the highest spreadsheet answer. Sometimes the best choice is the one you're least likely to screw up. And we still haven't mentioned taxes, because taxes could completely shift the answer depending on how the money is structured. Is the $1 million taxed immediately? Are the $6,000 payments taxable as ordinary income? Is the investment return taxable every year? Are capital gains involved? Are you in a high-tax state? These questions matter a lot. For example, if the lump sum gets hit heavily by taxes up front, the amount you actually get to invest could be much lower than $1 million. Meanwhile, if the monthly payments are taxed more favorably or vice versa, that changes the break-even point. So when people ask this question casually, they usually skip over the exact thing that determines the outcome. Details. Now let's make this practical. If I'm talking to someone who understands investing, keeps expenses under control, and thinks long-term, then I'd usually say take the $1 million now. Invest it carefully, build your own cash flow, stay diversified, let time and compounding work for you. But if I'm talking to someone who values certainty, wants income they can count on, and doesn't trust themselves with a large amount of money, I'd say the monthly payment might be the better real-world choice. And that's not weakness. That's self-awareness. Because the biggest financial advantage you can have is not intelligence. It's knowing yourself. If you know you're impulsive, build guardrails. If you know you're disciplined, maximize flexibility. If you know inflation matters, avoid fixed income streams without growth. If you know opportunity matters, value access to capital. So what would I choose? If this is a clean comparison, $1 million now versus a fixed $6,000 a month, I'd take the $1 million now. Not because the monthly payment is bad, not because $72,000 a year isn't attractive, but because the lump sum gives you more control, more upside, more protection against inflation, and more ways to turn capital into wealth. But the real answer is this. The better option is the one that matches both the math and your behavior. If you only understand the math, you can still lose. If you only understand your emotions, you can still make poor decisions. But when you combine both, you stop guessing and start making financial choices like someone who actually builds wealth. And honestly, that's the entire game. Here's a financial question that sounds like a trick, but it's actually one of the best ways to understand how money really works. Would you rather have $1 million right now, today, or $6,000 every month? Think about it for a second. $1 million now feels powerful, immediate, flexible. You can see it, touch it, invest it, move it. But $6,000 every month feels comfortable, stable, predictable. It feels like financial security. So which one is better? The answer is not based on what feels bigger. It's based on what's worth more. And if you want to make good financial decisions, that's the difference you need to understand. So let's calculate it. $6,000 a month means $72,000 a year. That sounds great. And if those payments continue forever, eventually you'll receive more than $1 million in total. In fact, after about 13 years and 11 months, the cumulative payments pass the $1 million mark. If you're only looking at raw total cash received, the monthly payment eventually wins. But that's not how finance works. You can't compare money across time without discounting it. That means you need to ask one simple question. What could I do with the $1 million if I had it today? Because if you take the $1 million now, you could invest it. And that investment return changes everything. Let's keep the math simple. If $1 million earns 4% annually, that's $40,000 per year. At 5%, it's $50,000. At 6%, it's $60,000. At 7%, it's $70,000. At 8%, it's $80,000. Since the monthly option pays $72,000 per year, your break-even return is 7.2%. That means if you believe you can invest $1 million and earn more than 7.2% over the long run, then the lump sum is probably the better financial choice. If your return is lower, the monthly payment may have the advantage. Now, this is where people usually make one huge mistake. They assume they'll earn strong returns just because the stock market historically has. But real life is messier than spreadsheets. What if you invest at the wrong time and panic sell? What if you keep half the money in cash out of fear? What if you start spending the principal? What if you use the money to fund a lifestyle instead of build assets? Then the theoretical return doesn't matter because you never actually get it. This is why behavior matters more than most people realize. A financially disciplined person sees $1 million as a tool. A financially undisciplined person sees it as permission. inflation. And those two mindsets create completely different outcomes. Now let's look at the monthly payment through the same lens. $6,000 per month might not maximize upside, but it does reduce the chance of catastrophic mistakes. You don't have access to a giant pile of money all at once. You can't burn through it in 1 year. You're forced into consistency. And consistency is underrated. For a lot of people, steady money beats big money. Not because it's technically superior, but because it's easier to manage. Still, there's a hidden weakness in the monthly option that people ignore: inflation. If the $6,000 is fixed forever, its value shrinks every single year. Maybe not dramatically at first, but enough that over time it matters. 5 years from now, it buys less. 10 years from now, even less. 20 years from now, it may feel much smaller than it sounds today. That's the problem with fixed income. It feels safe because the number doesn't change, but in reality, the number not changing is exactly the risk. Meanwhile, a lump sum invested into productive assets has the potential to grow over time. Not guaranteed, of course. Markets go up and down, but at least you're giving yourself a chance to maintain purchasing power. And then there's flexibility. This might be the biggest advantage of the lump sum. If you have $1 million now, you can solve problems immediately. You can pay off high-interest debt. You can invest during market downturns. You can buy assets at a discount. You can create an emergency fund, fund a business, or simply design your life with more options. Options have value. People often only compare income to income, but capital gives you access to decisions that monthly cash flow doesn't. That's why two people earning the same amount can have completely different financial lives depending on whether they have assets. Now let's imagine 3 different people. Person number 1 is financially savvy. They live below their means, invest consistently, and think long term. For them, the $1 million now is probably the better choice. They can create their own monthly income and still keep the potential for long-term growth. Person number 2 is average with money. They're not reckless, but they're not highly skilled either. For them, the answer depends on taxes, investment discipline, and whether they actually follow through with a plan. Person number 3 is impulsive. They spend emotionally, chase trends, and don't manage risk well. For them, the monthly payment may be far safer because it prevents one terrible decision from ruining everything. So when somebody asks, what's the correct answer? The honest response is, there's a mathematical answer and there's a personal answer. The mathematical answer depends on discount rate, inflation, taxes, and expected return. The personal answer depends on discipline, psychology, and lifestyle. And if you ignore either one, you could choose badly. Personally, if the choice is mine and the terms are clean, I'm taking the $1 million now. I'd rather have control. I'd rather have the ability to invest. I'd rather have inflation working with me than against me. And I'd rather create my own cash flow than rely on a fixed payment stream. But I also know that answer comes with responsibility. A lump sum only works if you treat it like capital, not consumption. That's the part nobody wants to hear. Most people don't lose money because they didn't have enough. They lose money because they didn't manage what they had. So if you ever face a decision like this in real life, don't just ask, which one pays more? Ask, what is the present value? What return can I realistically earn? How does inflation affect this? What are the taxes? How much flexibility do I want? And most importantly, what kind of person am I with money? Because once you answer that honestly, the decision becomes much easier. And that right there is the difference between people who chase money and people who actually build wealth.